Campus Activewear is among the few Indian players in the sports and leisure footwear segment and the only listed entity in the space. Its affordable price points, owing to presence across entry to semi-premium space in a market dominated by MNC players, makes it well poised to gain market share in a fast-growing segment. Campus is likely to deliver one of the fastest earnings growth and has the highest return ratios in the listed footwear space. It's among the quality stocks to be owned, and we recommend investors to add the stock. The sports and athleisure footwear market in India is poised to grow at 21% CAGR over FY22 to 25, outgrowing the footwear industry growth of 17%. Rise in awareness about health and fitness, growing influence of sports personalities and sporting events, increasing preference for casual wear for long-distance travel as well as vacations, and higher fashion quotient are the key reasons for increasing usage of S&A footwear. Campus is the largest and fastest growing scale brands in the S&A footwear market. It has a market share of about 7% in the overall S&A footwear industry and nearly 15% in the branded space. Campus is among the very few established Indian brands in the segment, which is primarily dominated by international players like Nike, Adidas, Reebok and Skechers. It has an average selling price of about 650 rupees compared to the average of more than 3,000 rupees for international brands. Owing to its pricing, wide product offerings as well as product quality, Campus has carved out a place for itself among consumers. It covers more than 85% of the addressable S&A footwear market in India and is well positioned to gain further share from these levels. Campus is enhancing its network presence through the traditional distribution model of company to distributor to retail multi-brand outlets. It would deepen presence in North and East India, where it has a relatively strong presence. Apart from the existing markets, Campus plans to enhance presence in the South and West of India, where it has relatively lower penetration. Remember, it derives about 30% of revenue from Tier 1 and metros, indicating huge growth potential in bigger cities across the country. Campus has successfully scaled up its D2C presence. The share of D2C has grown significantly from about 6% in FY19 to almost 40% in FY22, primarily led by the online channel. Campus's products are sold through third-party pure marketplace platforms like Flipkart, Myntra, and recently Amazon. It also sells via third-party online to offline B2B platforms such as Find and Udaan, as well as through its own website. Online platforms helped Campus create brand awareness in large cities, with the share of Tier 1 and metro revenue increasing from 17% in FY19 to almost 30% in FY22. Apart from the online route, Campus is also opening exclusive business outlets and tapping large format stores to reach consumers directly, as it aims to enhance the share of D2C revenue to 50% over the next 2 years. Campus is expected to deliver strong top-line growth of more than 25%, doubling the revenue over the next 3 years. Benefits of operating leverage and better raw material procurement owing to a larger scale of operations would lead to margin improvement. Enhancing the share of D2C, which is a high-margin business, will be a big plus. Campus is focusing on premiumization of the product portfolio. New launches are targeted at a high price point, and the share of semi-premium and premium products, which are typically priced above 1,000 rupees, has increased from 53% in FY19 to about 64% in FY22. Its average selling price has grown at an 8% CAGR over FY19 to 22, and we expect this trend to continue. Let's look at some peer comparison. Campus's profitability is better than Relaxo's but lower than metro brands. Lower profitability is primarily owing to lower gross margins compared to metro. Campus's working capital days are comparable to Relaxo's but higher than metro brands. Higher working capital days are owing to higher inventory because typically S&A segment has higher inventory as compared to any normal footwear company. However, Campus has high return ratios compared to both Relaxo and metro brands. Now, Relaxo has manufacturing in-house but also has lower profitability, leading to lower return ratios. Campus's return ratios are better than Metro's owing to difference in the distribution strategy because Campus has minimal company-owned stores, which requires less investment compared to Metro's entire sales coming in from company-owned stores. Campus has historically posted high revenue and profitability growth compared to both Relaxo and Metro brands. Now, we expect campus to maintain industry-leading earnings trajectory over the next 3 years. Its valuations are comparable to Relaxo's and Metro's based on FY25 projections. Given better return ratios and higher earnings growth, campus has scope to re-rate further even from the current levels.